Okay, so you're looking to get informed, maybe quickly, but definitely thoroughly. And you don't want that feeling of just being swamped with information.
Yeah, information overload is real.
Exactly. That's what we're aiming for here. Today, we're doing a deep dive into a book many call the single best guide on investing for, well, pretty much everyone, Benjamin Graham's The Intelligent Investor.
And the endorsement doesn't get much better than Warren Buffett, does it?
Right. Buffett says Graham gave him the emotional framework, the analytical tools. I mean, that's huge.
Absolutely. And our mission today really is to pull out that core wisdom from Graham's book, the stuff that's still incredibly relevant, even today.
Yeah, the timeless principles. We want to help you become that, well, that intelligent investor Graham talks about. So who's this guy, Benjamin Graham? Quite a story, actually.
Huh.
He had this early Wall Street success, made a 250% return in just one day.
Sounds amazing.
Yeah, except the company was a total fraud.
Ouch. A tough lesson early on.
Definitely. But it clearly shaped him. He became this super meticulous researcher, almost obsessive about digging into the details.
Like that Northern Pipeline story.
Exactly. He saw it trading at, what, $65 a share?
But he figured out it held at least $80 per share just in bonds, high-quality bonds.
So he bought in, pushed management for a better dividend.
And walked away a few years later with $110 a share. That's finding real hidden value.
That's the goal, right?
What's really striking is how prescient Graham was. Jason Zweig, who wrote commentary for later editions, points this out. Graham's warnings, his principles, they seem almost prophetic when you look back at things like the dot-com crash.
Decades later.
Decades later, yeah. The core ideas he laid out, drawing on market history up to the early 70s, they've just held up incredibly well through boom and bust. It really speaks to the lasting power of fundamental thinking.
So what does Graham actually mean by an intelligent investor? It's not just about IQ, right?
Not at all. He was very clear on that. It's not about SAT scores or raw brain power. It's much more about character traits.
Like what?
Patience, discipline, being eager to learn, but also, crucially, having emotional control and the ability to think for yourself, to resist the herd mentality.
So temperament over intellect, almost.
You could definitely say that it's a trait of character, as he put it.
Okay, let's dig into some of the big takeaways then. Where do we start?
Well, one of the first things Graham tackles is this illusion he saw developing, the illusion of perpetual growth.
Okay, what's that about?
He looked at the decades leading up to 1970, that post-war boom period. There was this feeling that you could buy leading stocks anytime, any price, and you were basically guaranteed to profit.
This sounds familiar, doesn't it? Like we hear echoes of that sometimes.
Exactly. But then the market drop in 69-70 happened. And for Graham, that was a reality check. A reminder that actually big falls are possible. It's the norm, historically speaking.
It's easy to get complacent in a long bull run.
Very easy. And Graham was really adamant that too much enthusiasm, especially on Wall Street, almost always leads to trouble, particularly with those secondary, third-tier stocks.
I've seen it happen before.
Repeatedly. And that really brings us to one of his absolute cornerstones, the margin of safety.
Right. This is maybe his most famous concept.
It's certainly one of them. And it's not about complexity. It's simple, but profound. It's the idea of building in a buffer.
How so?
You don't pay full price, essentially. You buy a security only when it's selling for significantly less than your estimate of its intrinsic value. That gap, that's your margin of safety.
It protects you if your analysis is a bit off or if things just go unexpectedly wrong.
Precisely. It's the foundation, he argued, for getting good results without taking undue risks. He even warned against chasing huge returns without really understanding the potential downsides and building in that safety cushion.
And dealing with risk. I mean, markets go down. It happens. It can feel scary. What was his advice there?
He was very practical about it. He accepted that prices will fall sometimes. You can't avoid it.
So don't try to time it perfectly.
Exactly. The key is managing that risk and, crucially, managing your own fear when it happens. Don't let panic drive your decisions. Develop a rational, long-term viewpoint.
Easier said than done sometimes, but critical.
Absolutely.
Now, another really key distinction he made was between investing and speculating. These weren't just words to him right now.
Oh, not at all. This was fundamental. For Graham, investment requires thorough analysis first. You're looking for safety of your principal, your initial money, and a satisfactory return. Not necessarily a spectacular one, but satisfactory.
And speculation.
Speculation, he said, is more like gambling. It often relies on guessing market psychology, not business value. The odds, he felt, are stacked against you, kind of like in a casino where the house has the edge.
And he had that great line, investors make money for themselves.
While speculators make money for their brokers. Through commissions, frequent trading, all that activity, it really makes you stop and think about why you're making a trade.
It does. Okay, so speaking of things that sound good but might be risky, what about those obvious growth prospects? The industries everyone says are the future.
Yes. Graham was very, very skeptical about those.
Why? Isn't growth good?
Growth itself is good, yes. But the problem is, by the time an industry's growth potential is considered obvious by everyone,
It's already priced in.
exactly, and often overpriced, the market's expectations get baked into the stock prices, often excessively so. Just because a business is growing rapidly doesn't automatically mean its stock is a good buy at that moment.
Like everyone piling into the same hot trend.
Pretty much. He saw it happen time and again. Think about, say, the internet boom.
Right, dot-com era.
It was obvious the internet was huge. Loads of companies had amazing growth stories. But how many actually delivered sustained profits and good long-term returns for investors who bought at the peak?
Not that many in the end.
Yeah.
Lots of flameouts.
Precisely. He'd point to things like the fate of some internet funds back then, or hyped stock picks. It's a cautionary tale. Obvious growth doesn't equal guaranteed profit. The market often gets ahead of itself.
So if chasing those hot growth stocks isn't the way, especially for a more conservative or defensive investor, as Graham called them, what did he suggest for building a portfolio?
Well, traditionally, for that defensive investor, he liked a simple, balanced approach, often something like a 50-50 split between high-quality bonds and a diversified portfolio of established stock.
50-50, okay, straightforward.
But, and this is important, he was dogmatic. In the early 70s, for instance, he actually noted that market levels were quite high.
Hmm.
So at that specific time, he felt it was hard to justify having more than 50% in stocks from a value perspective. It shows his principles were guidelines, adaptable to the current environment.
Right, not rigid rules set in stone.
Mm.
And for the bond part of that 50-50, what were the main things to think about?
A couple of key things. First, the tax issue. Are taxable corporate bonds better for you? Or tax-free municipal bonds? That depends entirely on your individual income tax bracket. He showed how to calculate that.
Okay, so it's personal.
Very personal. Second, he touched on the length of the bond, the maturity, longer versus shorter terms. That ties into managing interest rate risk, which he discusses more later.
And anything else for bonds?
He also mentioned U.S. savings bonds, especially back then, as a really solid, safe choice for individual investors who prioritize simplicity and security.
Got it. Now, you mentioned the defensive investor. Graham had another category too, right?
Yes, the aggressive, or as he often called it, the enterprising investor.
What's the difference?
The defensive investor wants safety, simplicity, and just satisfactory results. They aren't trying to beat the market necessarily, just participate sensibly.
Okay.
The enterprising investor, though, is willing and able to put in significantly more time, more effort, more research.
To try and get better returns.
Potentially, yes. Through more detailed analysis, maybe looking at less obvious opportunities. But Graham stressed, both approaches can work. The key is self-knowledge. You need to pick the path that fits your personality, your available time, and crucially, your emotional discipline.
Knowing yourself is key. So where did growth stocks fit in for these two types? You mentioned defensive investors should probably avoid them.
Generally, yes. He saw most growth stocks, especially the really popular ones, as too speculative for the defensive investor.
Why speculative? Because of the price.
Primarily, yes. Their prices often reflect very optimistic future projections rather than current earnings. That makes them vulnerable if anything goes wrong, or even if growth just slows down a bit. He used examples from his time, like IBM or Texas Instruments, huge successful companies. But even they had periods of significant price drops.
And we could probably name modern equivalents easily.
Absolutely. Think Microsoft, Cisco, many others at various points. Even the best can stumble, or just get ahead of themselves valuation-wise. He noticed prices often rose much faster than the actual profits did for these popular stocks.
So for that defensive investor again, if they're avoiding trying to pick the next hot growth stock, what alternatives did Graham suggest for participating in the stock market?
One very practical technique he advocated was dollar cost averaging.
Ah, yes, I've heard of that. Investing a fixed amount regularly.
Exactly. Same amount of money, say every month or every quarter, regardless of where the market is. When prices are low, you buy more shares. When prices are high, you buy fewer.
And over time, it averages out your purchase price.
potentially giving you a better overall price than if you tried, probably unsuccessfully, to guess the market's highs and lows. And he noted that index funds are basically perfect for this. Take stock picking out of the equation entirely.
Makes sense. He also mentioned something intriguing. Special situations. What are those?
Yeah, those are interesting. They're opportunities that pop up because of specific corporate events. Think mergers, takeovers, spin-offs, liquidations, things like that.
So not just buying regular stocks.
Right. Historically, Graham found that if you had the expertise to analyze these situations properly, you could sometimes find opportunities with good potential returns and, importantly, calculable risks.
Calculable risk. Okay.
But he also warned that these had become more difficult over time. More competition, more complexity chasing these deals. Less low-hanging fruit, you might say.
Sounds like he wasn't a fan of trying to jump in and out of the market based on forecasts, market timing.
Definitely not. He was deeply skeptical of market timing. He really viewed it as speculation, not investment, like trying to predict coin flips consistently.
The odds are against you.
Pretty much. He loved that old Rothschild saying, buy cheap and sell dear.
Simple enough.
But he contrasted it with what he often saw on Wall Street, which was more like buy high and sell low, driven by emotion and herd behavior. He pointed out how various market timing formulas and theories had failed historically.
So sticking with the defensive investor, if they aren't timing the market and maybe not comfortable picking individual stocks or analyzing special situations, what's left?
Well, for them, he strongly suggested looking at investment funds.
Mutual funds, basically.
Mutual funds, yes, or similar vehicles like common trust funds if you had a larger amount to invest, or even hiring reputable investment counsel. The point is professional management and diversification. Let someone else handle the day-to-day stock selection.
Okay. What about new companies coming to market? IPOs. Initial public offerings often get a lot of hype.
Graham was generally very wary of IPOs, especially for the average investor.
Really? Why? Seems exciting.
He saw a clear cyclical pattern. IPOs boom when markets are hot, often fueled by hype, and then they tend to bust. The public often gets drawn in near the peak and ends up getting burned when reality sets in. Prices are often inflated initially.
Cautionary tale there, too. Now, switching back to the enterprising investor, the one doing the homework, what kind of analysis did Graham think was essential?
For them, it was all about rigorous, deep analysis of the financials, really understanding the numbers.
More than just the latest quarterly report.
Oh, much more. He stressed looking at earnings over several years, maybe 5, 7, even 10 years, to get a real sense of the company's stable earning power, not just a snapshot.
Smoothing out the eames.
Exactly. And he warned about watching out for things labeled non-recurring costs or charges that somehow kept recurring year after year.
Sneaky accounting.
Potentially. He also talked about calculating a past performance value as a starting point and being wary of companies relying too heavily on debt, what he called other people's money, or OPM.
Interesting. What about dividends and stock splits? Investors often like seeing those.
Graham had a specific take. On dividends, his view was kind of a profitable company should pay them unless it has a very compelling, profitable reason to reinvest that cash internally. The burden of proof was on management not to pay.
Okay, so default to paying dividends and stock splits.
He was mostly dismissive of stock splits. He saw them largely as cosmetic. They don't change the underlying value of the company, just slice the pie into smaller pieces. He felt they were often used just to create buzz and encourage trading rather than benefit long-term owners.
Just psychology, not substance.
Pretty much his view, yeah.
He also talked about shareholder rights and management quality. That seems important, but maybe overlooked.
Very important to him. He reminded shareholders that they are owners of the business. And as owners, they have a right to expect reasonably competent and ethical management acting in their best interests.
And if they don't think they're getting that,
He suggested shareholders shouldn't just be passive. They should engage, maybe vote against management proposals, or even advocate for bringing in outside experts to evaluate the business if things seemed really off track.
taking ownership seriously.
Exactly.
And thinking about management. Conflicts of interest are a big topic today. Did Graham have warnings there?
Absolutely. While he wrote before scandals like Enron, the underlying principle was clear. He stressed the danger of misaligned interests. Shareholders needed to read the proxy statements, understand how executives were compensated, look for related party transactions, anything where management's interests might diverge from the owners. Transparency was key.
It all comes back to doing your homework.
Always.
Graham also seemed concerned about companies just sitting on huge piles of cash.
Yes, he questioned that trend. If a company builds up enormous cash reserves, but isn't reinvesting it effectively in growth and isn't returning it to shareholders via dividends or sensible buybacks, then who is really benefiting?
Good question. Is it just hoarding cash?
Maybe. He felt large idle cash balances didn't necessarily help the outside stockholders much. He also touched on how stock buybacks and executive options needed careful scrutiny to ensure they truly benefited shareholders long term, not just management in the short term.
Okay, let's circle back to that core idea, the margin of safety. You mentioned his view changed a bit by 1972.
Right. In his update, then, he made a pretty stark observation for the time. He basically said that, on average, the typical stock price in the market didn't offer much of a margin of safety anymore.
Why not?
Because stock earnings yields the earnings per share divided by the price had fallen to levels very close to the interest rates you could get on safe bonds.
Ah, so stocks weren't clearly cheaper relative to bonds anymore.
Exactly. Unlike, say, back in 1965, when stock yields were much higher than bond yields, offering a clear valuation advantage. By 72, that gap had closed. Stocks, on average, weren't cheap enough to provide that buffer he looked for.
So does that mean no investments met his criteria then? What about those special situations?
No, he clarified that. Even if the average stock wasn't attractive, specific opportunities could still exist. A thoroughly analyzed special situation where you had a strong reason to believe the outcome would be profitable and you understood the risks. That could still qualify as a sound investment operation, even in a generally expensive market. The margin of safety was specific to the individual opportunity.
Got it. He even went into some really niche areas like warrants.
Yeah, that was an interesting, more advanced example. He talked about buying very low-priced, long-term common stock option warrants.
That sounds speculative on the surface.
It does. But his logic was about probabilities and limited downside. If a warrant cost, say, pennies, but gave you the right to buy a stock for years to come, there's a chance the stock could rise significantly, making the warrant very valuable. The potential gain could be huge relative to the small initial cost.
So the low price itself created a kind of margin of safety based on favorable odds.
That was the idea. An extreme example, maybe. But it showed how his principles could be applied even in unconventional ways, always focusing on potential value versus price paid and risk assessment.
And to really drive his points home, he included that appendix, the super investors of Graham and Doddsville. That sounds important.
It's incredibly powerful. He profiled several investors who were his students or close followers who had achieved truly outstanding long-term results.
Like who?
People like Walter Schloss, Tom Knapp, Ed Anderson, Bill Ruane, and famously, Charlie Munger, Buffett's partner.
Wow, big names.
Right. And what Graham highlighted was they all had different styles. Some held lots of stocks, some very few, but they shared the same core philosophy.
Which was?
Buying businesses, not just stock tickers, buying them at a significant discount to their estimated intrinsic value, focusing on limiting risk. That margin of safety principle was central to all of them. He even mentioned a corporate pension fund, FMC Corporation, that saw huge improvement after hiring managers who followed these value principles. It was real-world proof.
And the Washington Post example from 1973, that really shows the gap between price and value, doesn't it?
It's a classic. The entire company's market value was something like $80 million.
Okay.
But Graham and others estimated its underlying assets, TV stations, the newspaper itself, other holdings, were worth conservatively at least $400 million, maybe much more.
A huge discrepancy.
Massive. It showed how the market can sometimes completely misprice a solid business. And for the investor who understood the real value, that low price wasn't high risk. It was a huge opportunity. The margin of safety was enormous.
Incredible. One last area, complex math. Lots of fancy models in finance today.
Yeah.
What was Graham's take?
He was actually pretty wary of over-reliance on complex mathematics in investing.
Why?
He favored simple arithmetic, basic algebra, grounded in common sense and experience. He felt that overly elaborate formulas could create a false sense of precision, maybe mask flawed assumptions, and even disguise speculation as rigorous investment. Keep it understandable, keep it grounded in business reality.
Makes sense. Simplicity can be powerful. So it sounds like his ideal hunting ground might be those solid, maybe slightly boring companies.
Often, yes. He suggested looking at that Middle ground, well-established companies, maybe not the most exciting growth stories, but with consistent earnings, solid balance sheets, companies the market might be overlooking because it's chasing the next big thing.
And because they're overlooked.
They might be trading below their intrinsic value. They might offer that margin of safety. There's a wide universe of these kinds of companies, providing plenty of scope for analysis and diversification.
Okay, so wrapping this all up, if we boil down this deep dive into Graham's wisdom, what are the absolute must-remember principles for listeners?
Well, number one, always, is that margin of safety, building a buffer between price and value.
Critical?
Number two, know the difference between investing based on analysis, safety, satisfactory return, and speculating. Don't confuse them.
Right.
Third, do your homework. Thorough analysis of the business and its long-term fundamentals is essential. Don't just rely on recent numbers or hype. Fourth, be skeptical of market fads and crowd behavior. Enthusiasm often leads to overpaying. And finally, perhaps the hardest but most important, cultivate patience, discipline, and emotional control. Your temperament is key.
And that definition of the intelligent investor, it really comes back to those traits, doesn't it? Not genius, but character.
Exactly. Patience, discipline, learning, controlling emotions, thinking independently. That's what Graham meant. It's accessible, but it requires effort and self-awareness.
So maybe the final thought for everyone listening is this. Take a hard look at your own approach to investing right now. How does it stack up against these timeless principles from Graham?
In today's market, with all its noise and volatility.
Right. Are there places where bringing in more of that disciplined, value-focused, truly intelligent investor mindset could actually serve you better in the long run? Maybe it's worth picking up The Intelligent Investor again, or for the first time, and really thinking about how its wisdom applies to you.